The shares of Netflix fell by around 10% in extended trading despite a solid quarter. But what investors are worried about is the weak guidance ahead. At first glance, the numbers look pretty strong. Revenue and profits beat expectations that were helped by one-off gains. And experts are saying that growth could be getting harder to sustain in an increasingly saturated streaming market. For consumers, the bigger story is pricing. Netflix has recently raised subscription costs again, continuing a trend that has been witnessed across the country. Premium ad-free viewing is becoming significantly more expensive, while lower-cost plans are increasingly coming with advertisements that create a clear fork in the road. Pay more for convenience or accept ads for affordability. The shift has suggested that streaming is moving closer to the traditional television model many users once left behind. Now, ad-supported tiers are no longer a side offering. They are, in fact, becoming central to growth as more subscribers are opting for cheaper plans. Expect more ads, tighter content windows, and possibly even differences in viewing experience across tiers. Content remains the main battleground. Big budget shows and global hits still attract users, but the pressure to keep delivering them is rising as competition intensifies. At the same time, companies are in fact becoming more selective with spending, which could mean fewer experimental experiences, leadership changes, including the departure of co-founder Reed Hastings from the board and also mark a transition phase. Now, the company is evolving from its founder visionary era into a more performance-driven business for viewers. The takeaway is pretty clear. Streaming is no longer the cheap, ad-free alternative that it once was. Instead, it's becoming an ecosystem where cost, content, and convenience are increasingly intertwined. For all the latest news, download the WION app and subscribe to our YouTube channel.